Hello traders, Gary Wagner here. It is 1240 in Honolulu, 540 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 19th day of January 2024, and this is the Weekend Review. After the sharp decline resulting in a loss of just over $40 that occurred on Tuesday and Wednesday, that is these two large red candles here, we had a pretty nice recovery yesterday, gaining $16 on the day. We did issue a trade alert entering our long position at $2,024. We sent out the trade alert after the close in New York and about a half an hour into the open in Australia. Today, we had gold gain moderately, $7.70, or a net gain of 0.38%, with February futures currently fixed at $2,029.30. We remain long from 2024 with a stop at 2005. The first chart I want to look at is a 1-hour Henkin-Ashi, or Japanese average chart of gold futures. We can see the strong decline that occurred at the beginning of the week, and we could see how that really waned by the size of these Henkin-Ashi candles and the emergence of upper wicks, and then the pivotal candle from a small red body to green candles. This trend itself began to really pick up steam over the last couple of hours of trading in Europe. It did decline going into the close and then went back to green, but I would like to see that trend a little bit stronger. It has waned in terms of the strength of the uptrend. As for our current trade, it was really based upon not only the fundamental backdrop, a escalation of conflict in the Middle East, including additional strikes by the U.S. military, but the initiation of the trade alert itself was based on a couple of technical indicators. First of all, when we look at the recent low, this is back before the October rally when we saw gold trade to a low just above $1,820. Our next low was higher, followed by a higher low, and then again by a higher low. So we had three higher lows after hitting this low last year. The second thing is, as it came down, and we had been in a defined downtrend since gold hit the second of the all-time record high closes back at the end of December, it did trail down to the low that we saw on Wednesday and a really strong $16 recovery. It opened just above the close of the prior candle, so we could not label it as a piercing line. For a piercing line, you need to have this green candle open below it, but we could label it loosely as a bullish harami, and that's what I talked about on yesterday's show. When it gapped higher on the open in Australia, that was a signal to me to issue a buy recommendation, because the gap itself moved above 2025. It's a significant level based upon the 38.2% fib retracement. It did have a higher high and a higher low than the previous day. It opened and closed higher than the previous day. We will have to see if we get follow-through buying next week. The other thing that we can notice is we're definitely seeing a compression of range. Whenever you get a series of higher lows and lower highs, that forms that compression triangle. Initially, we put our stop at $2,005. It remains there currently. It was based upon the low that we saw gold trade to on Wednesday. That came in roughly at a 209 in terms of the close. We put it below the tail at 207. That is where we derived a stop at 2005. In terms of our upside target, I believe that it has the potential easily to challenge 2070. That is the wick or the high that we saw earlier this week. This is the wick of Tuesday. And that is our initial assessment in where I believe we could exit the trade if it moves in our anticipated direction. at the beginning of the week. The U.S. dollar and its strength certainly had a tremendous impact on gold, taking it lower. I draw your attention to this large red candle. This occurred on Tuesday. During that day, gold traded higher to the tune of 0.76%. Concurrently, gold dropped about a full percent. So 3/4 of that drop can be directly attributed to dollar strength. But as you can see, Wednesday, Thursday, and today, although we had a slight decline today, they are all moderate moves. The one thing that we can see when we look at this chart is we were trading sideways with resistance at 102.43, corresponding to the 61.8% Fibonacci retracement. That retracement is from a fairly long data set beginning back in July of last year up until the top that occurred in October, when the dollar index hit a high above 107. And so we consolidated for a couple of weeks. We then had this gap up, and it looks as though it's consolidating, forming a new base at this higher level, which also corresponds to the 50% retracement. I don't believe that this retracement number is as strong as the 61% was, mainly because we see activity such as this bottom that occurred back in November, showing that this particular price area was an area of support at that time. We purposely did not include silver in our trade alert yesterday, and that is because I didn't see a real sign of a potential uptick. This is yesterday's candle, this small-bodied green candle with a medium-sized lower wick. What that told me is that unlike gold that had a huge variation between the open and closing price, we didn't see the same thing in silver. It was below what I believe is a major point of potential resistance or support. It was supportive right in here. It did break and then move back up last week, but I really would need to see break back above $22.95 to $23 before I became bullish enough to issue a buy signal in silver. For right now, we remain neutral with no active trades in silver. This has been Gary Wagner, wishing you as always good trading. We will talk to you after the weekend for the next daily update and review. Bye-bye.